Something unprecedented just happened in the silver market, and if you're not paying attention, you could miss one of the biggest financial shifts of our generation. I'm talking about first notice day for the March 2026 silver contracts on the Chicago Mercantile Exchange. Friday, February 27th, 2026. Most people have never heard of first notice day, but what unfolded that day could change everything we know about silver prices. Here's what happened. The COMEX, which is the commodity exchange division of the CME group, had just 88.1 million ounces of registered silver available for delivery. That's physical silver sitting in warehouses, ready to be handed over to contract holders. But here's the problem. The open interest, meaning the total number of contracts demanding delivery, represented somewhere between 366 million and 400 million ounces of silver. Let me repeat that. Paper contracts existed for up to 400 million ounces, but only 88 million ounces of actual silver were available to deliver. That's a ratio of more than 4 to 1. Some analysts believe the real paper-to-physical ratio across all silver markets reached as high as 356 to 1 by late 2025. This isn't just a supply and demand imbalance. This is a full-blown crisis in the making, and it all came to a head on first notice day. In the next 20 minutes, I'm going to walk you through exactly what first notice day revealed, why the CME halted trading just before this critical date, how China's new export controls are strangling global silver supply, and what happens next when the paper silver market collides with physical reality. Whether you're an investor, a metals trader, or just someone who wants to understand what's really happening in global markets, this story affects you. Because when a market this size breaks down, the ripple effects touch everything from industrial production to currency stability to your personal savings. Let's dive in. The crisis nobody saw coming. First, let me explain what first notice day actually is, because understanding this is critical to grasping why February 27th was so important. The CME operates futures contracts for silver. These are agreements to buy or sell silver at a specific price on a specific date. Most traders never intend to actually take delivery of physical silver. They're just betting on price movements. They buy low, sell high, or vice versa, and pocket the difference. Historically, only 3 to 5% of futures contract holders actually demand physical delivery. The other 95% settle in cash. They close their positions before delivery ever becomes an issue. First notice day is when this changes. It's the first day that holders of short positions, meaning people who sold silver they don't own, must notify the exchange of their intent to deliver actual physical metal, and buyers who want the real thing must stand ready to accept it. This kicks off a 3-day delivery cycle. Day 1 is the intent notification. Day 2 is when warehouse receipts, called warrants, get transferred. Day 3 is when the physical metal can be withdrawn from the vault. For decades, this system worked smoothly. A small percentage of traders took delivery. The rest rolled their positions forward to the next month or exited in cash. No big deal. But 2025 changed everything. Total COMEX silver deliveries in 2024 were 203 million ounces. By 2025, that number more than doubled to 474 million ounces. And by February 2026, the delivery demand rate hit 98%. 98%. Nearly everyone was demanding physical metal. The game had fundamentally changed. And the exchange was not prepared. On February 11th, 2026, registered COMEX silver inventory fell below 100 million ounces for the first time in modern history. Against this, the March contract had open interest representing over 10,500 contracts. Each contract is 5,000 ounces. Do the math. That's 52.6 million ounces just in March alone. And that doesn't count the massive positions rolling over from previous months. The physical metal simply wasn't there. The emperor had no clothes, and everyone was starting to notice. The suspicious trading halt. Now here's where things get really interesting and controversial. 2 days before first notice day, on Wednesday, February 25th, 2026, the CME group suddenly halted trading. They called it a technical failure. Silver was trading just above $91 per ounce at the time, testing recent highs. Momentum was strong, and then, without warning, the market went dark. This wasn't the first time. On November 27th through 28th, 2025, the CME experienced a catastrophic 10-hour outage. That halt occurred on first notice day for the December silver contract. Reports circulated that a Chinese industrialist had notified COMEX of intent to take physical delivery of 30 million ounces of silver. Shortly after the exchange came back online, silver prices began a historic rally. That rally saw them more than double to $121 over the next 2 months. Was this coincidence or something more deliberate? Critics argue these halts are not random technical glitches. They point out that the CME had no major outages in the previous 5 years. Then suddenly, when silver is hitting all-time highs and physical delivery demand is overwhelming the system, the exchange goes down. Twice. The timing is difficult to ignore. There's a long history of allegations that large banks, particularly JP Morgan, hold massive short positions in silver. The theory goes that these institutions suppress prices. This allows them to accumulate physical silver at artificially low prices while profiting from their short positions. Whether you believe this is deliberate manipulation or just market dynamics, the pattern raises serious questions. When the market is under extreme stress, why does the exchange keep experiencing convenient outages? The CME blamed technical issues, but many traders aren't buying it. They see a system protecting itself. The margin hike strategy. When a futures market gets too hot, the exchange has a weapon. Margin requirements. Margin is the amount of money traders must deposit to hold a futures position. It's like a security deposit. If the market moves against you, the exchange can demand more money to keep your position open. If you can't pay, you're forced to liquidate. In early February 2026, the CME implemented its third margin increase in just 10 days. On February 6th, they raised silver futures maintenance margins by 20%. This was on top of previous hikes. The stated reason was to cool the volatile market. Silver had surged past $120 in late January, then crashed to $64 in a matter of hours on January 30th. That's a 47% drop. The CME said they needed to ensure market stability and protect against excessive risk. But here's what margin hikes really do. They force leveraged traders to either inject more capital or close their positions. And when you're holding a long position hoping to take physical delivery, a sudden margin hike can blow you out of the market before you ever get your medal. It's a perfect tool for discouraging physical delivery demand. Make it expensive and risky to hold your position. Force people to sell before first notice day. Silver dropped to around $77, but then it rebounded strongly, gaining over 17% in 1 week. Despite the margin hikes, despite the violent price swings, despite the exchange halts, the delivery demand didn't disappear. Traders wanted their medal, and they were willing to ride out the chaos to get it. This tells you something profound. The demand for physical silver isn't speculative gambling. It's real. Industrial users need it. Strategic investors want it. And they're not being scared off by exchange games. The industrial demand explosion. This isn't 2011, and it's not 2021. In 2011, silver spiked to nearly $50 on speculative fervor and inflation fears. In 2021, the Wall Street Bets crowd on Reddit tried to engineer a short squeeze in silver. They wanted to replicate the GameStop phenomenon, but it fizzled. There wasn't genuine industrial demand. 2025 and 2026 are different. The demand driving this squeeze is real, and it's coming from industries that cannot function without silver. Solar panels require silver for conductivity. Electric vehicles use silver in their electronics. Artificial intelligence data centers need massive amounts of silver for servers and electrical infrastructure. 5G networks, medical devices, water purification. Global solar installations alone are projected to consume over 130 million ounces of silver annually. Electric vehicle production is accelerating. The AI build-out is insatiable. And here's the problem. Global silver mine production is roughly 880 million ounces per year. Industrial demand is over 600 million ounces and rising. Investment demand is surging. Central banks in some countries are quietly accumulating silver as a monetary hedge. There simply isn't enough supply to meet this demand, not at current prices, and certainly not when everyone wants physical. The futures market has become a fractional reserve system. Exchanges like COMEX issue far more paper contracts than they have physical metal to back them. This works when most want cash, but when real buyers show up, it breaks. The China factor. On January 1st, 2026, China changed the game. The Chinese government reclassified silver from an ordinary commodity to a strategic resource. What does that mean? It means silver exports now require government licensing, and Beijing is very selective about who gets those licenses. Only 44 companies received authorization for 2026. Why would China do this? Because silver is essential to their technology and industrial ambitions. Solar panels, EVs, electronics, defense. China wants to ensure domestic industries have priority access. This sent shockwaves. Silver in Shanghai surged to $102, while Western spot prices were around $91. That's a 16% premium. Silver in Shanghai was worth significantly more. Normally, arbitrage traders would exploit this gap. Buy in the West, sell in China. But export controls make this difficult. This created a bifurcated market, physical silver in different geographies trading at different prices. The lease rates told the story. In London, silver lease rates spiked to 34.9%. Intraday peaks hit 39%. Think about that. Nearly 40% annually just to borrow silver. That's not normal. That's desperation. Someone was short and scrambling to find physical metal. The lease rate is the price of their panic. China's controls, surging demand, collapsing inventory, all collided on first notice day. What happens next? So what happens when the March delivery cycle concludes? What are the possible outcomes? Let's look at the scenarios. Scenario 1. Orderly delivery at reduced volumes. Maybe some dealers manage to source silver from other inventories. The squeeze eases and the market stabilizes at a higher price level. This is the optimistic scenario. Scenario 2. Forced cash settlement. The CME forces some contracts to settle in cash. Buyers who wanted metal get dollars instead. This would undermine confidence. Why trade futures if you can't get the metal? Scenario 3. Force majeure, the nuclear option. The exchange declares extraordinary circumstances and suspends normal terms. This would cause chaos. Prices would decouple violently. Trust in the CME would crater. Scenario 4. The squeeze intensifies. They scramble to source enough for March, but this just kicks the can down the road. April and May contracts are already building. Eventually, something has to give. The bigger picture. This isn't just about silver. It's about trust in financial markets. It's about the difference between real assets and paper claims. Silver might just be the first domino. Gold, copper, platinum, all are vulnerable. The registered COMEX silver inventory at 88 million ounces represents less than 2 months of global industrial demand. That's a razor-thin buffer, and it's shrinking. Some predict it could hit zero in months. Bulls believe this will force prices to $150 or even $300. Bears argue high prices will incentivize recycling. The truth is in between. But first notice day was a warning shot. Let me recap the critical points. The March 1st notice day revealed a massive imbalance. Trading halts raised suspicions. Margin hikes failed to discourage demand. China's controls intensified the squeeze. If you're an investor, this is a clear signal. Physical silver is undersupplied. Consider the difference between owning physical silver versus paper contracts. Physical metal in your possession cannot be cash settled away. When a market breaks down this publicly, it's rarely an isolated event. It's a symptom of deeper structural issues. The paper-silver market has been running on faith and leverage, and that faith is being tested. What happens next will tell us if this system can adapt. Stay informed. Pay attention to what's beneath the headlines. Thank you for watching. Hit that like button and subscribe. I'll see you in the next one. Stay sharp.